Today's video will be a simple one. I'm going to talk to you about 3 stocks that I quite like and that I'm invested in outside of my main portfolio that you see on this channel. I'm not going to go too deep into the CEO and the history of the firm. I'm not going to do some sort of financial modelling. I'm just going to give you some simple reasons why I like the stocks and why I'm invested in them. Talk a little bit about markets and go from there. So yeah, that's that. For those of you that don't know me, I'm Jack. I'm a full-time investment analyst for a wealth management company. I am a CFA charter holder. I have a degree in finance, so I'm not the smartest person in the world. I don't know the most about finance in the world, but I like to think that I know a thing or two. And stock picking is not for the faint-hearted. It's not the easiest thing in the world. I've been right just as many times as I've been wrong, and chances are these stocks could go to 50% down within a year. So take everything I say with a grain of salt. I sort of just do this for fun and to try and eke out some extra gains on top of my funds. But with that covered off, let's come on to the main core of the video. Just before we do that, just need to remind everyone that this is not financial advice. This video is for education and entertainment purposes only. Right, stock number 1, and it's quite a good one due to market timing, is Jet2. So this is a UK small cap stock that I invested in literally 2 or 3 days ago off the back of a profit warning. I actually sold a UK smaller companies fund to fund the purchase of Jet2 and one other stock that I'm not going to talk about today. And literally the day I sold it, Jet2 issued a profit warning and was down 10%. So I got in at a 10% discount, which is nice. But the main basis behind this, well, there's a couple of reasons. First is valuation. So the easiest way, or one of the most surface level, sort of top down level metrics you can look at for valuation of a company is price to earnings, and the lower that is, generally the better. Jet2 has a very low valuation. It's about 7 times forward PE, which is normally sort of levels you'd see where company isn't growing anymore or there's some sort of existential risk to the company. So about a year and a half ago, British American Tobacco, the cigarette company, was trading at about 7 times PE when I bought it. And that was basically priced to go out of business. And obviously it did a re-rating since then. It went up quite a lot due to the pouches and things. Velo, don't know how to say it. But Jet2 is a profitable business. It's growing fairly quickly. I think a lot of the valuation story is due to the UK small caps more broadly being out of favour. And then when you think about sort of sentiment around the British consumer, it is probably one of the lowest it's ever been. So Jet2 has been double hammered by that. Valuations are low, it's profitable, they pay a dividend, I think it's about 1% yield, and more recently, in their most recent earnings call, they announced a share buyback. Now that basically means that they think, or they want to tell the market that they think the shares are undervalued. They're happy to buy, I think it's about 8% of their market cap, which is huge for a buyback, and the share price jumped like 20% at the time. It's now down to about the same levels as pre-announcement, so you're getting quite a good deal in my opinion. I'm happy to hold this for the next 2 or 3 years, let the buybacks do their work. If the share price keeps falling, with how much cash Jet2 have on their balance sheet, I would not be surprised at all if they announce more buybacks, which will only be even more accretive to shareholders, especially at these low valuations. So that's Jet2. The next one is Barclays. Now there are some more technical reasons for this, but again, the big overarching one is valuation. Now, but Barclays has had a great run, along with many banks globally, especially in the UK and Europe, over the last year or so. I think I'm up like 60 or 70% on this, which is pretty crazy. But the reason I'm still happy to show it in this video and showcase it now is, again, the valuation point. Typically, sort of fair value for an average bank would be 1 times price to book, typically. I mean, that's very crude, but what that basically means is if their balance sheet, all of their loans, I mean, this is very crude, but say their balance sheet was worth £100, they've given out £100 worth of loans, the value of their loans is £100, then the share price should be £100. At the moment, I think Barclays' price to book is about 0.7. So if they had £100 worth of loans on their books, then their share price would be £70. Now, when they're buying back, again, 6, 7, 8% of their shares per year at a discount to price to book, that is very accretive to book value growth, especially if their underlying loans are good. And I sit with a lot of UK fund managers in my job. I don't pretend to be a bank analyst. I don't analyse bank stocks on a daily basis, but the people who do have very high conviction in their performance going forward. And that is not insider trading, before anyone starts screaming at me in the comments. That is publicly available information. You can go on their websites and find their thoughts on banks. And yeah, that's the brief of it. I also think, again, the UK sentiment piece, consumer side and on the stock side, is overblown. I think, yes, I mean, Labour are making a mess of things and doing their best to destroy any semblance of a strong economy. But if you look at the household savings ratios and how much excess cash there is on UK consumer balance sheets, you look at real wage growth, I think, especially given how well capitalised they are and the sort of rejigs that they've had post GFC, great financial crisis, they're in a very good spot. They're almost completely different entities than they were 10, 15 years ago, and the market hasn't quite yet come to terms with that, in my opinion. So Barclays is the second one. And then finally, almost opposite to Jet2 in terms of timing wise, we've got Google. Now, Google I've held since the Liberation Day crash because it was on a 19 times PE relative to the market, which was about 21 times. And when you've got I think it's the most profitable company in the world, and it's still trading at a discount to the market, and it still trades at a slight discount to the market. In my opinion, that's almost a no-brainer. Now, it did have the antitrust ruling hanging over it more recently, and it has a lot of, again, that sentiment piece. It has a lot of negative sentiment around AI and whether AI will disrupt search, which is about 50% of their revenue. But the antitrust thing was cleared in the last couple of weeks, which has seen the share price shoot up about 15-20%, hence why I say it's bad timing. But yeah, for me, buying pretty much, I mean, Google's a verb, isn't it? Like, I'm going to Google something. It's an absolute beast. The AI is, I saw a chart this morning on Twitter, and it was the search on Google, funnily enough, for Gemini versus ChatGPT, and Gemini is rapidly catching up to ChatGPT. I think one of the cases I've seen is ChatGPT is sort of a silo. Yes, it's got its sort of video creation and stuff, but Google's is better. But it's sort of a silo. What Google can do is leverage any AI developments it has amongst existing products. So YouTube, it can integrate AI. Waymo, which is the self-driving stuff, it can integrate AI. Search, it can integrate AI. And yeah, from what I hear from many sort of experts and people that use AI on a daily basis, Gemini is one of the leading softwares. I think if you've used Perplexity AI as opposed to Search, that is a bit of a warning sign. Google has now got an AI search function, but I think there is a lot of uncertainty. But ultimately, when I play this back in my head, and the reason I bought Google in the first place, is you don't get to buy one of the best companies in the world at a discount to market unless there is some uncertainty. So ultimately, you've got to take the good with the bad. You know, there's a reason you're buying it at a discount, in my opinion. And if you sort of can look through that, you think they're going to be able to innovate through and leverage AI to be a beneficiary as opposed to a someone who loses out, then I think Google is a good play. And of all of the AI plays, Google is definitely the one that has the most reasonable valuation, in my opinion. Again, to reiterate, they're at a discount to the market, despite being one of the AI leaders. And you'd think with all of the AI buzz at the moment, Google stock would be doing quite well. Obviously it has, but that's sort of been a separate thing. It's been an idiosyncratic AI antitrust sort of situation. So that was a bit of a ramble. I didn't really know how to go about doing this video because it's the first one I've done where I've just sort of spat 3 stocks at people. I will probably do this again. So if you have any recommendations as to how I can improve it, which you probably do, leave them in the comments. If not, I'll just fire 3 more ideas at you in a couple of weeks and ramble at you for another 10 minutes. So if you enjoyed the video, please leave a like and share it and subscribe and do all of that good stuff. And I'll see you in the next one.